Hello everyone, and welcome to part 2 of my lecture on cost, volume, profit analysis on chapter 18. And where we left off on the last video is that we explained what cost behavior was and how we classify costs into two categories depending on how they behave when volume increases, either variable costs or fixed costs. So let's take a look at what that whole relationship between cost, volume, and profit and fixed and variable costs looks like. All right, so here is yet another graph. And again, on the horizontal axis, you're going to see volume in units. And then on the vertical axis, you're going to see the dollar amounts, okay? And in this graph, we're going to graph both costs and revenue. So the first green line you see here is our sales line, okay, or revenue. So this is our sales dollars. And of course, if we don't sell anything, we have no sales dollars. But if we sell 1 unit, now we have more. If we sell 2, now we have more. If we sell 3, now we have more, and so on and so forth, right? The more units you sell, the more revenue you get, okay? Now, the second line here, this red line, is your fixed costs. And as you can see, and as we discussed, fixed costs stay the same no matter how many units you sell. If you sell 1, it's this amount. If you sell 2, it's this amount. If you sell 100, it's this amount, okay? It's always going to be the same amount. By definition, that's what a fixed cost is it stays the same regardless of changes in volume. Okay, then we have our third line, and that's the blue line, and that is going to be your variable costs. So, sorry, it says here variable costs, okay? And your variable costs, we're going to start where your fixed costs were, because your fixed costs, you can't get rid of them, right? That's like your rent. Even if you, like, say you rent an apartment, if you decide not to sleep at your apartment, say you're going to, spend the night at your parents' house, they're still going to charge you rent. So that doesn't go away even if you decide not to live in your apartment. So we start our total cost, our variable costs, at where our fixed costs left off. And our variable costs, as you can see, are going to increase as our volume increases. Because again, this is things like direct material, direct labor. The more you make, the more materials, the more labor you need. Okay, so those are variable. They're going to increase as your volume increases. Okay, so now you can kind of see the relationship between sales, fixed costs, and variable costs. And this line here actually represents total cost, because your total cost is your fixed costs plus your variable costs, because the company has both fixed and variable costs. So your total cost is this blue line right here. Now, what you see in this quadrant right here is your loss, okay? Because you have sales. This is this green line, but in this area, your costs are higher than your sales. So you are losing money in this little triangle right here. Okay. Then, right here, you have what we call the break-even point. And the break-even point is where the amount you're selling is exactly equal to your costs. So you're not making money and you're not losing money. And then once you hit this break-even point, any sales on top of that are now in this profit range because your sales are higher than your costs. So really, this is where you want to be. But as managers, we want to identify exactly what is our break-even point, and so that way we can aim to start making a profit. So again, the break-even point is a unique sales level at which a company neither earns a profit nor incurs a loss. So you guys might have heard this term like break even when you go to Vegas. Breaking even means, maybe you won some hands, maybe you lost some hands, but at the end, you came out zero. You didn't make any money, you didn't lose any money. That's kind of what a business is trying to do. To identify their break-even point. Of course, they want to make money, but you go at a minimum, I have to break even because then I know I'm at least covering my costs. I haven't lost any money. I want, of course, to do more than break even, but at a minimum, I have to do break even to make sure that I cover my costs. So when we actually start getting into understanding start doing the calculations for CVP analysis, the book gives you so many different formulas. And I just think that there's only one formula you need to know. And I'm going to show you in class how you can use this one formula to answer all of the many different types of questions that they're going to ask you in this chapter with just this one formula. So I want to make sure that you really know this equation. Okay, this is the equation for the contribution margin income statement. So first of all, let me explain what contribution margin is. Contribution margin simply means sales minus variable costs equals your contribution margin. Okay, so you've heard that term margin before, gross margin and things like that, but in this case, we're going to focus on contribution margin, okay, which is sales minus variable cost equals contribution margin. So once you've covered your variable costs, that's your contribution margin. From there, you subtract out your fixed costs that don't change with how much sales you have, and that gives you your pre-tax income. Okay, we're not going to deal with taxes right now because I want to keep it simple for you guys. So again, to go over it again, sales, right? So sales are variable, meaning the more units you sell, the more sales dollars you're going to have, okay? Variable costs are also variable. So the more units you sell, the more variable costs you have. So here, for contribution margin, we're really just isolating the variable pieces of the puzzle, right? Sales are variable, variable costs are variable. So the variable portion of our income is contribution margin. Then from there, we subtract out the fixed costs, and that gives us our pre-tax income or operating income, because we're not going to deal with taxes. Because taxes are a whole different category, neither fixed nor variable. So, or they're variable, but not based on number of units. So we're not even going to talk about taxes right now. But to relate this to something you've seen before, and to show you that it's all kind of the same thing, it's just rearranging the income statement. So the regular income statement that you guys have learned is sales minus cost of goods sold equals gross profit, minus operating expenses equals pre-tax income or operating income. So what we're doing here is we're just rearranging this income statement. We're saying within cost of goods sold, some elements are variable and some elements are fixed, right? We talked about that. Variable things would be things like direct materials and direct labor. Fixed costs would be things like factory rent or factory depreciation. Okay? Within operating expenses, those again are your selling, general, and administrative expenses. There are elements of your operating expenses that are both variable and fixed. So for example, variables would be things like sales commissions, right? Because those are going to increase if you sell more. Fixed things, again, are going to be things like rent or salaries, because those don't change whether you sell or produce more items. So what we're doing here, it's really just rearranging and recategorizing. Instead of categorizing by what is a cost of goods sold or an inventory product cost versus a period cost, which is going to be our selling, general, administrative expenses, instead we're going to categorize costs based on if they're variable or fixed. So again, within variable costs, you're going to have some that have to do with the product, some that are going to have to do with the selling general administrative expenses. Under fixed costs, you're going to have some that are product related, some that are selling general administrative expenses. But either way, you'll reach the same income number. We're just rearranging it like this. So, like I said, in this video, we're not even going to get into calculations. We're going to be doing that in class. There are a few calculations in your pre-class assignment because I want you to start kind of playing with the numbers a little bit, but we're going to really get into the numbers more in class, but I want to make sure that you understand the terminology, fixed and variable, that you understand the formula, which is, again, this contribution margin income statement, just that you know the formula, and that you know the purpose, why the heck we're doing it, what questions does this help managers answer, and that way we can move forward in class on Tuesday. Thanks a lot, and I will see you in class.